Hello, this is Bob Steele. In this video, we will be talking about adjustments for adjusted gross income. Our objectives will be, we will be able to list adjustments for adjusted gross income, define the tax rules for student loan interest, define and discuss the health saving account deductions, define and discuss the deduction for moving expenses, define and discuss the deduction for half of self-employment taxes, define and discuss the deduction for alimony paid. So first we want to take a look at the accounting equation, or the tax equation, I should say, the tax equation here that we have been looking at, and we've been basically trying to work through this tax equation and see the different components in it in some order. We looked at gross income last time, and remember that the tax equation is basically an income statement. So we looked at the gross income, the income piece of it. Most of what we're going to look at now are the deductions side of it. We're going to look at the deductions and see what types of things can be deducted. Of course, from an accounting standpoint, deductions are generally thought of as expenses that are incurred in order to help generate revenue. So that's kind of the normal rule for deductions. Deductions that we incur in order to generate revenue in the same time period are generally deductible as well for taxes. But, of course, the tax code has other types of deductions because the tax code is trying to influence us to do certain things and to act in certain ways. So we do have other deductions that are unrelated to income that were included in the tax code for various reasons. These deductions up here are probably not the ones that we most know, well known for most people, because the deductions like the charitable deductions and the home mortgage interest and stuff, those are down here in the itemized deductions. So we'll talk about those at a later time. These deductions up here do not have a limit that they need to surpass, whereas the itemized deductions do. Itemized deductions need to be greater than the standard deduction in order for them to have a tax benefit to us, whereas the deductions above the line, they call it, this being the line for adjusted gross income, or deductions for adjusted gross income, do not have this cap that they basically have to exceed. Therefore, the deductions up here, if they qualify, they will be deducted for all taxpayers, whereas deductions that are in the itemized area generally will not be deductible for individuals, usually of lower income individuals who don't have enough itemized deductions to be over the standard deductions. So as we go through this, just keep in mind, picture in your head the tax equation, which is going to include this area up here. This is where we're talking about the above the line deductions, or the deductions for adjusted gross income. So adjustments for adjusted gross income include, so we'll just list them out here and then we'll get into some more detail about some of them. So we have the health savings account deduction. They're going to be on form 8889. And notice that once again we're going to group these deductions and calculate these deductions on a separate form, and then we'll bring them over to the first page of the 1040, whatever the net result is. And that's going to be a basic structure of many of the areas of this tax formula. You could think of this tax formula kind of like the 1040, the front page. But of course, to get to any one of these line items, we need to have some more calculations. We're going to have to do some calculations on a different sheet, bring that number into this lead sheet. So we also have the moving expenses. So we'll talk about moving expenses. Those are basically related to a job. If we had a change in job, then it would be deductible. So that's form 3903. Deduction for part of self-employment tax. So if we had our personal business, then we have to pay self-employment taxes similar to us paying payroll taxes now, which includes Social Security and Medicare. And we'll talk about that briefly. One half of that will be deductible, and we'll talk about the reason for that. And we have the self-employed SEP, simple or qualified plans. These are going to be retirement type plans, which are going to be deductible on the front page, on the first page of the 1040. So these are related to if we are self-employed, then we can invest in a retirement plan and get a deduction for that. Self-employed health insurance deduction. So once again, if we're self-employed, we have our own business, a Schedule C, then we can deduct the health insurance. Alimony is deductible as opposed to child support. So alimony will be deductible if we pay the alimony. It'll be deductible. If we receive the alimony, we have to include it in income. Student loan interest. So if we have a qualified student loan, the interest on that loan can then be deductible. So let's take a little bit more detail into that. We'll start off with the student loan interest. So in order to be deductible, and once again we're talking about being deductible on that first page of the 1040. So we're talking about we calculated income, then we're deducting these to come to adjusted gross income. So in order for the interest on a loan, student loan, to be deductible, it has to be a qualified education loan, which is and includes a loan incurred by the taxpayer solely to pay for qualified education expenses incurred on behalf of either the taxpayer, taxpayer's spouse, or any dependent of the taxpayer at the time the loan was incurred. So those are the individuals that qualify for the loan that would then be deductible. The interest would then be deductible at the taxpayer's spouse, or any dependent. And of course it has to be a qualified loan for the educational expenses. And the qualified educational expenses then include tuition, of course. That would be the main reason for the loan. Any kind of fees, books. So some institutions include the books in the tuition, some do not. So if we were required to get extra books, supplies, equipment, room, and board, as well as transportation, all included if we got the loan for these reasons. Notice that what is not included is meals. So it's assumed that meals will be needed no matter where we go. Therefore, the meals are generally not included as something that we can spend the loan money on in order to be able to deduct the interest at a later time. So now we have the health savings account deduction. So health savings is a tax-exempt savings account and used for qualified medical expenses, can be used for expenses of account holder, spouse, or dependent. And to be eligible for the HSA, the taxpayer must be self-employed or an employee of an employer with a high deductible health plan, or an employee of a company that has no health coverage and has purchased a high deductible policy on his or her own. So the idea being that if we have a high deductible plan, we will then be paying money out of pocket in order to pay for health benefits, and that out of pocket money can be deductible if we use this health savings plan. So if we had an employer that didn't have health insurance, or if we had an employer that had a high deductible health insurance, then it would be possible to set up this health savings account deduction account, which would allow for out-of-pocket basically expenses for medical expenses to be deducted above the line on page 1 of the 1040. Moving expenses. So moving expenses applies only if a taxpayer moves due to a change in job location or the obtain of a job. So notice moving expenses isn't something that a taxpayer is going to get every year, but if for some reason it came up that we were going to move at a particular time because of a change in a job, so the move was due to a change in the job, then at that point we could decide to deduct some of the moving expenses on the 1040 page 1. Those expenses that could be included include moving household goods. So obviously the moving of furniture and whatnot, that would clearly be part of the move. Traveling from old residence to new residence, including lodging but not meals. So if we took the road trip to travel, then that would be deductible. Remember, the meals generally are not, because it's thought that we would have to eat meals anyways. And moving expenses of persons other than the taxpayer if they are members of the taxpayer's household. So obviously if there are other members, basically the dependents of the household, that were moving along with us, then their travel expenses as well could be deductible. Storage of household goods within a consecutive 30-day period after items are moved from the former home. So if we had to remove the furniture, put it in the storage before we had access to a new residence, we could deduct the storage for up to 30 days on that. And notice what is not on here are things like the search for the house. So house hunting, flying back and forth to deal with things before the move happened, setting up types of arrangements at the new location. That's not on here. What's basically on here is going to be the stuff that's directly related to the move. And in order for it to qualify, the new job location must be at least 50 miles further from the taxpayer's old residence than the old job location. So obviously the idea being that we moved because it's in order for us to be able to accept the job. So therefore they put this arbitrary kind of mile check in there so that it could be seen that the move was clearly related to a job. So we didn't just pick up and move for some other reason. We moved in order for employment. And of course, that's what the tax code is trying to incentivize us to do, to be employed. So that's the purpose of the deduction. So the taxpayer must be either a full-time employee for a period of 39 weeks during the 12 months immediately following the arrival of the new area, or a full-time employee for at least 78 weeks during the 24-month immediately following the arrival in the new area. So what this test is trying to do is basically say we want it to be we only want the deduction to be related to if it's a permanent job. So obviously we don't really know if we're going to be there for sure clearly when we make the move, but we know if it's a temporary job. So if we were going to move it for a temporary position, that generally wouldn't qualify for the moving expense. And so this regulation is basically in there to say, okay, the plan, of course, was to move for a full-time move, and that's why we took the deduction. Deduction for half of self-employment tax. So once again, remember, we're talking about that second line on the tax equation. So we're deducting above the line for adjusted gross income and 1/2 of self-employment. So self-employed individuals essentially pay both the employee and employer portion of the Social Security and Medicare. So little detail on this. Notice that anybody pays Social Security and Medicare. So if you're a sole proprietor, you pay Social Security and Medicare, meaning those are the payroll taxes, and your employer matches that Social Security and Medicare payment. Now, when someone is self-employed, meaning even if we don't even have any employees, we're just self-employed and we're doing our own business, then it would be a tax advantage to them if they did not have to pay Social Security and Medicare when an employee does. Therefore, the self-employed individual does have to pay Social Security and Medicare, and not only do they have to pay their portion, but they have to pay the employer portion. So if we're self-employed, meaning I'm the only person working in my own business, then the IRS considers me both the employee and the employer, and they consider the net income that we generate from the employment as similar to wages. Therefore, we have to pay both the employee and the employer portion of Social Security and Medicare, the payroll taxes. Now, so that kind of evens out basically the idea of someone being incorporated and paying wages versus someone being self-employed. But the company that has the employee also gets to deduct the employee portion of the taxes. So they have to pay the employee portion of the taxes. They have to match Social Security and Medicare, but at least they get an expense. They get a deduction that reduces their net income and has them pay less taxes. Therefore, in order to kind of even the playing field, the half that we consider to be the employer half of the self-employed taxes is deductible on the front page of the 1040. So basically, we're going to calculate self-employment. We're going to calculate the self-employment income, net income. Then we're going to calculate basically the self-employment tax, and then we're going to deduct half of it, not on the Schedule C, but on the first page of the 1040. So that's how that's going to work out. So 1/2 of this tax is deductible, and the calculation is on Form SE. So self-employment health insurance deduction. So once again, we're talking about that second line on the tax equation, the above-the-line deduction. And the health insurance for self-employed individuals is generally deductible. So a self-employed individuals may be able to deduct 100% of self-employed health insurance payments. So if we have the own business, we may be able to deduct the health insurance. The deduction may not be greater than self-employed income. So if our net income on the business is less than the insurance, then we can't deduct more than the amount that we made as income on the business. And this is going to be a common theme in tax code. The IRS does not like to see losses. Obviously, the idea of taxes from an IRS standpoint is to generate money. I don't like to call it really revenue. We generated the revenue. They're gonna try to get money for expenses of the government from the revenue that we generated. And obviously, if we have a loss, then that reduces the amount of money. If the question is that loss going to be deductible? So if we had a business that had a loss, we could take that loss against our W-2 income. And obviously that is not good for for the government, because that reduces the amount of taxes they're going to get. So obviously the IRS tax code is going to be very skeptical of losses. So there's going to be a lot of except if there's a loss type of ideas, or if there's a loss, we have to do something different with it, and those are going to come up commonly. And if the taxpayer is entitled to participate in any subsidized health plan maintained by any employer of the taxpayer or the taxpayer's spouse, a deduction is not allowed. So if they have access to another health option. Alimony. So a basic rule on the alimony is deductible, child support is not. So what you need to understand on alimony and child support is basically when a divorce happens, obviously there could be payments from one spouse to the other. And in terms of the divorce, it's not always clear, but in terms of the taxes, we have to somehow decide what amount of that payment is alimony and what amount of that payment is child support, because for tax purposes, child support is considered to be for the child, and therefore, no matter who the child lives with, I guess the logic behind this is it was considered to be something for both spouses, because it's both spouses' child theoretically. So if one spouse pays the other spouse because the other spouse is taking care of the child, then the spouse that pays it does not get to deduct it, and the spouse that receives it does not have to include it in income. On the other hand, if it's alimony, then the alimony is I guess the essence of the alimony payment is that, one individual may have been doing more of taking care of the family business, while as the other individual may be doing more working, and therefore the working individual would have to pay the payment for the other spouse who was spending most of the time doing the non-income generating stuff, but the stuff that is vital to the household. So clearly that payment is given out, and in that, for tax purposes, for some reason, that is deductible for the person who pays it, and the person therefore who receives it has to include it in income. And notice this is the idea for much of taxes. If someone gets a deduction, someone else has to include it in income. So for the IRS, it kind of evens out all over the place. So notice that if a company pays wages, they get the deduction, but the employee has to include it in income. So the employer then is paying less taxes, but the employee is paying more taxes. That's going to be the way most things work. So in this case, if the alimony is deductible for the person who pays it, then the person who receives it has to record it in income. So notice what happens in the divorce is that if you have an amount of money that's getting paid from one person to the other, the person that pays it is always going to want to call it alimony so that they get the deduction. But the person who receives it does not want to call it alimony, because they would have to then include it in income and pay taxes. The person who receives the money is going to want to call it child support, because when they receive the money, they then don't have to include it in taxes. But the person who pays the money would rather kind of put it in alimony, at least from a tax perspective, so that they wouldn't have to pay it. So that's an interesting point that does come up. All right, so objectives. We are now able to list adjustments for adjusted gross income, define the tax rules for student loan interest, define and discuss the health savings account deductions, define and discuss the deduction for moving expenses, define and discuss the deduction for half of self-employment taxes, as well as define and discuss the deduction for alimony paid. Thank you.